I'll start again. Morning. I'd like to welcome everyone to this multi-location, that means hybrid meeting of the Pension Committee, which is open to the press and public on request. This meeting will not be broadcast live. However, a recording will be made available as soon as possible after the meeting has concluded. We welcome the use of the Welsh language at meetings. I've had no requests for people to speak Welsh today, so this meeting will be conducted in English only. May I remind members that as per statutory guidance made under Section 4 of the Local Government Wales Measure of 2011 and our formally adopted hybrid meeting policy, any member attending a meeting remotely must be able to be seen and heard by the members and officers who are attending the meeting, as well as by members of the public viewing the meeting. So can I ask that you both use your cameras for the duration of the meeting. Please can members attending via Microsoft Teams refrain from using the chat function and instead use the raised hand icon to indicate when you want to speak. Please remember to keep your microphone muted when you are not talking. Everyone happy with that? Marvellous. Right, moving on to the agenda then. Agenda item number 1, attendance and apologies. Jade.
Thanks, Chair. I haven't received any apologies for today's meeting.
Fantastic. I'll give apologies for Alfie Best for lateness in the first instance, if you can note those, please. Agenda item number 2, declarations of interest. That's back to Jade.
Thanks, Chair. If I could just confirm the following declarations of interest. Councillor Hawler, I have that you are a contributor to the fund.
Correct.
Thank you. Councillor Williams, I have that yourself and your wife are in receipt of a pension and are contributors to the fund.
Correct.
Thank you. Councillor Gordon, I have that yourself, wife, stepdaughter and your stepdaughter's partner are contributors to the fund.
That's correct, yes.
Thank you. And yourself, Chair, I have that your father and 2 other family members are in receipt of a pension and you are a contributor. And could I just also confirm, Councillor Gordon, I have that you have a personal interest due to your work as a Unison official.
That's also correct, yes.
Thank you.
Put my microphone on. I'll say that again. Agenda item number 4, minutes of the Special Pensions Committee for the 18th of November 2024. Again, any issues from members in the room on camera? No, in which case I'll take those as read. Thank you very much. Agenda item number 5, again, this is for information. The draft minutes of the Pension Board meeting of the 24th of October 2024. These are for noting only, although as you're online, Ian, is there anything that you discussed at the board meeting that you'd like us to be aware of specifically?
Thank you, Chair. No, I have nothing to add to the draft minutes as presented. Thank you.
Thank you very much. Item number 6 then is the first substantive item. This is the administration update from Joe.
Thank you, Chair. Right, just starting with My Pensions Online. So you'll be able to see that the numbers registering for My Pension Online continues to increase, and now 36.84% of the total membership are registered. The large increase was due to members accessing their annual benefit statements in August. So the fund continues to encourage members to register for this service and will continue to do so going forward. Cyber security. So I continue to meet with the Chief Information Security Officer on a monthly basis to assess the fund's cyber security risk. In recent weeks, cyber attacks have been on the increase as a result of the UK budget and ongoing support for Ukraine. So our Chief Information Security Officer has undertaken several measures to protect the fund, including monitoring the fund's websites and web-based applications, working with third parties, for example, our software provider, and carrying out penetration testing on websites to ensure its safety. So the Chief Information Security Officer continues to do this while the risk level is high. Just an update as well on the annual tabletop exercise. So this is an exercise that the Chief Information Security Officer and myself carry out with Hayward Pension Technologies, who provide us with the multi-administration system. So that was carried out last week. And the Chief Information Security Officer was of the opinion that the attendees portrayed knowledge of their areas and what needed to be undertaken, and that Hayward Pension Technologies had the necessary policies and plans in place to handle a cyber attack, so no issues were found. And this exercise will be repeated again next December. Just moving on then to MacLeod. So as you know, the fund continues to work on MacLeod, and all business as usual cases are being processed. Work has begun on the rectification process. We've been identifying historical cases where members have the underpin, and processes have been carried out to check these records to determine whether they are genuine underpin or whether the records need to be corrected. And the fund is also assessing resources and expected to recruit hopefully 2 additional members of staff in the coming months to help with the MacLeod project. Moving on to the dashboard. So the fund has purchased Hayward Pension Technologies Integrated Service Provider, which will assist the pension fund in connecting with the pensions dashboard. And the fund must connect by the 31st of October of next year. The systems team received some training on the ISP last week, and now we have begun a period of user acceptance testing, which will run through into the new year. So further updates will be provided to you at future meetings regarding that. Moving on then to point 8 of the report and the Pension Regulator's General Code of Practice. So the General Code of Practice came into force on the 28th of March 2024, and it consolidates and modernises 10 of the previous codes, including the Code of Practice 14, into a single set of standards. So it applies to governing bodies of occupational schemes, including the local government pension scheme. And there are 5 broad sections which are covered in the report. So the code sets out in detail what the pension regulator expects in the scheme to ensure that it's managed and governed effectively. And the pension regulator expects the funds to carry out an assessment of this on a regular basis to make sure that it's meeting the requirements of the code. So in order to assist the fund, we've purchased Hyman Robinson's General Code of Compliance Checker, and that covers all the LGPS relevant areas of the code. And the tool will enable the fund to gauge current compliance levels and monitor ongoing progress. So since the code was launched in March, the fund has begun to carry out a self-assessment of compliance, and the self-assessment has been broken down into 15 distinct subsets. So on page 45 and 46 of your report, we provided a work-in-progress assessment of where fund officers believe that we are for each individual requirement. And these have been marked either as fully met, partially met, or not completed. So out of the 156 measures, the fund fully meets 76 of the requirements, partially meets 25, and 35 requirements are not yet completed. Where we have stated that we've met the requirements, we have documented evidence for that as well. So partially met, where we've partially met areas, we've identified steps that we need to take in order to ensure compliance, and are putting these measures in place going forward. And the areas not yet to be reviewed, the areas not yet completed, we haven't carried out a full review of these as of yet. So we will do that, and we'll provide a further update to committee at a future date. And further details regarding this are available in the Pension Board reports from October.
I might stop you there before you go on to the breaches policy, because that's something we haven't considered before. I think it might make sense to take that in one go. But do any members have any questions or issues they'd like to raise off the back of the first items on that report? David.
Thank you, Chair. To ask Joe, are the things that are not met, are they all things that apply to us, or are there some things that don't apply to us because of our position as an LGPS?
These would all apply to us. The checker that we've purchased is specifically for the LGPS, so it would be everything that the checkers identified that we haven't yet met. But an example of this could be a policy that needs updating, which we're going to move on to the breaches policy. If that is approved by committee, then that then would affect our scores, and we would then meet some of the requirements of that. But they are all LGPS specific.
Thank you, Joanne. I've got a question, but either Carl or John, any questions on the report thus far? No. Okay, I've got a question, and actually it's probably in my gift at some point to do some work on it. I'm just wondering, will we be sharing information and doing any comparison across the funds within the WPP and or across the LGPS to see where we stand on this?
That's nothing that we've discussed with the other Welsh funds at the moment. It's something that I can raise at the Welsh Officer Group to see if they're willing to share their results with us. We are trying to work together as Welsh funds to make sure that we cover everything, and if people have got processes and procedures in place that we can adopt, then we will take advantage of that. So we are trying to work together as much as possible, but I can discuss sharing the results as well.
I think that would just be quite helpful to work out where we are relative to the others as well. Okay. If nobody's got any more things to add on the report thus far, back to Joanne to talk us through the breaches policy.
Thank you, Chair. So the breaches policy was last reviewed and approved by committee in September 2021. And as I just mentioned, the Pension Regulators Code of Practice came into force in March 24. So we've carried out a review of the new breaches requirements set out in the code, and we've identified several areas of the policy that require updating. And as I said, once these are updated, that will then have an impact on our score and will enable us to meet some of the additional requirements. So the areas in the main relates to where we are required to report to other bodies and where contributions have not been paid on time. And then further details of those are available in 9.3 of the report. So what we've done is we've drafted a revised breaches policy which takes into consideration the additional reporting requirements, and we've also taken the opportunity to update the policy more generally to include the new terminology used within the General Code. The breaches policy was taken to Pensions Board in October, and it was endorsed by the members ahead of formal consideration by the Pensions Committee today. So I'd like to ask Pensions Committee to note the content of the report and also approve the revised breaches policy under Appendix 1 for the reasons set out in this report.
Okay, thank you, Joanne. So, members, any questions on the substance of the breaches policy in the appendix or anything else? Also, actually, again, Ian, is there anything germane from the meeting of the board, particularly that you'd like to talk us through?
Thank you, Chair. No, the board were happy with the revised policy and no additional requests for amendments.
In which case, as nobody's indicating, can I draw members' attention then to page 47 and recommendations which start at 10.1. So the recommendations are that the Pension Committee A, note the content of the report, and B, approve the revised breaches policy under Appendix 1 for reasons set out in the report and as endorsed by the local pension board following their work in this area. I think we can take them both together. Is everyone happy to endorse those recommendations? Fine, fantastic. Thank you very much. There you go, Joe. And still with Joanne, we've got agenda item number 7. This is the administration strategy that starts on page 63.
Thank you. Thank you, Chair.
There's a ghost somewhere.
So the purpose of this report is to seek approval from Pensions Committee to publish the Pension Administration Strategy, which is available in Appendix 1. So Regulation 56 of the LGPS regulations gives the discretion to administering authorities to prepare and publish a pension administration strategy. It's good practice for pension funds to have an administration strategy in place. And recently, the local government fit for purpose consultation has indicated that it will become a mandatory requirement moving forward. So the pension administration strategy should outline the performance standards to be achieved by the fund and its scheme employers to enable provision of a cost-effective and high-quality pension administration service. And the fit for purpose consultation will also increase consistency, believes it will also increase consistency of how administrative matters are approached across the scheme and drive improvement in administration of pensions. So the purpose of the administration strategy is to ensure that the fund and scheme employers understand their roles and responsibilities, that accurate records are maintained, the fund and employers have the necessary and appropriate skills to carry out their work, that fund and scheme employers demonstrate compliance with scheme governance, that communication processes are in place between the fund and employers to enable them to engage effectively, that services are developed digitally wherever possible, and that clear performance standards are set out and monitored to ensure efficient administration and pension services. The Pension Administration Strategy was presented once again to the local pension board at their July meeting. And in accordance with best practice, a consultation then was issued by the fund between the 7th of October and the 15th of November, inviting any feedback from interested stakeholders. We did receive 2 responses from scheme employers, and their comments have been reflected within the administration strategy in Appendix 1. So, in recognition of the Government Fit for Purpose consultation, fund officers have considered indicative requirements as well, as outlined to date in the consultation, and these have been reflected in the final version as well. The policy will be reviewed every 3 years in line with the proposals set out in the Government Fit for Purpose, and will be revisited again once the consultation is closed and the outcome of that consultation is fed back to us. So if Pensions Committee do agree to the Pension Administration Strategy, we will publish this on our website and circulate it then to all our employers. So I ask Pension Committee to note the content of the report and to approve the Pension Administration Strategy.
Okay, thank you, Joanne. And before I ask anybody else to speak, I just want to say, put on record, say thank you very much for the work that you've done, that Alex and the rest of the team have done. This is a significant piece of work that's been undertaken across this year, and indeed we've made a big deal about it in the annual report as well. And I think it's really good that we've taken the initiative and we've got ourselves in this position, especially looking at the other work that's going to have to come off the back of the pensions review. We've now actually got our house in order, so we can take this forward and do it seriously. So thank you very much and well done. Ian, before I bring in any other members, just to say again, any reflections from the board meeting in July or general reflections on this, as I know it's something that you've been a champion
of. Thank you, Chair. Yes, the board made a number of suggestions at the meeting, and those have now been absorbed in the final version, which you have before you. So no additional comments beyond those that have already been made and taken on board. Thank you.
Fantastic. Members, any issues or questions? I'll look to the screen first before David has his hand up. David.
Thank you, Chair. Just a couple of questions, really. First is, you indicated this is like to become mandatory, so is there somebody that this will need to be reported to or shown to, i.e. is there a standard that would be expected? First question. Second point is that do we do any kind of benchmark to sort of see how ours is in relation to others, picking up on the Chair's point in the earlier item? And thirdly, to say that I thought it was very readable and clear and well laid out.
Yeah, I'd like to echo that last point as well. Well done. Joanne.
Sorry. Thank you for those comments. Yes, I think we've been in need of a pension administration strategy for so long, so I'm pleased that we've got it to this stage now, and moving forward, I think it's going to help the fund and our employers, work together and go forward into the future. The strategy doesn't need to be reported to anybody, but we will publish it on our website so it can be viewed by anybody who has interest in that. And with regards to benchmarking, as part of this exercise, I did carry out a review of a number of different pension administration strategies across the UK, and I tried to pull out the best parts of each of those to come up with the strategy that's presented before you today.
Okay, anybody else? No, in which case then, can I draw people's attention to recommendation 6 on page 64 of the report. We worked out the problem with the ghost. Right, so the recommendation is 6.1. It is recommended that the Pension Committee note the contents of the report and approve the pension administration strategy. Members, we happy to agree? Excellent. That's passed then. So well done. That was worth all the hard work. Next item is agenda item number 8. This is Alex. And it's the Wales Pension Partnership WPP update, which starts on page 99.
Thank you, Chair, and morning to members both in the room and those online. As ever, this is a quarterly standing item on your agenda, and we're essentially reporting on activity that was presented to the Joint Governance Committee of the WPP as of the 18th of September. As ever, these reports have a sort of 3-monthly lag, and that meeting was presented in June 24 data, so it's quite a lag, but elsewhere on the agenda we've got more up-to-date figures and content for members' perusal. Just to draw on the fact that the next formal meeting is actually tomorrow, and so we're about a week out of being able to provide you with real-time update, but that will now follow through in the meeting in March 2025. There are a couple of items on the agenda today to cover some specific WPP consideration, so it's a relatively light-touch report. As ever, on page 100 of your papers, we've referenced the fact that the JGC minutes for the meeting are available in the appendices, and there's also, obviously, these are publicly available meeting papers, and therefore you can access them via the link we've provided. I will just touch on a couple of the examples, or a couple of points from the operator update in a second, but in the middle part of page 100, you can see a snapshot from that operator update, which outlines specifically the pension fund's exposure to each of the sub-funds that have been made available by WPP, but that actually does reflect 31st of October data, so where I mentioned there is a lag, those are the most up-to-date numbers that we were able to provide at the point that we prepared the papers. Just before I turn to the recommendations then, if I just touch on a couple of points from the operator update itself, which is starting on page 109 of your pack. If we actually just move through to page 112, page numbers are on the left-hand side for those that are following. This is an outline of the total value of each of the sub-funds that have been created within the ACS structure. So these are all of the funds that are managed by Russell Investments via Waystone. As you can see, this is 30th of June numbers, but there was about just under $9.5 billion in the equity mandates and a further $3.5 billion across our fixed income product. So that's just under $13 billion that is actively managed within the WPP sub-funds. Page 113, this gives you a breakdown of where that exposure sits across those sub-funds relative to each of the respective constituent authorities. You can see Torvine's exposure, or Greater Gwent Pension Fund's exposure there, sort of middle to right-hand side of that table. Again, really reiterating the information, but pages 114 and 115 basically present this information via pie charts. As a reminder, the Gwent Fund is invested across global opportunities, UK opportunities, emerging markets, and sustainable active equity. The latter does have all 8 participating authorities. And in respect of fixed income, that's across global credit and the global government bond funds. The remainder of this document really is for information. It covers some of the corporate updates that Waystone formerly Link Fund Solutions. As you all recall, that acquisition took place last year. So there's some updates there, which includes the various engagement that Waystone are having routinely with WPP, be it with the host authority, Carmarthenshire County Council, or via either the Officer Working Group or Joint Governance Committee. I'm happy to pause there, Chair, and take any questions, if there are any on the contents of the report.
Thank you, Alex. I think just to flag up, if everyone's all right with it, I think hopefully we should move through the agenda quite quickly today. We've got the two exempt items at the end. I'm also going to see if people are willing to stay for an informal conversation after the end of the formal meeting to have an update about the pension review and what that means for the fund and both the WPP. So I think some of the data in this report will be relevant when we come back later on. So I think, not fobbing you off at this point, but I'm just saying we'll come back to this for an informal conversation at the end of the meeting. David.
Thank you, Chair. So, looking at page 113, Alex, and I think it's very helpful to see that sort of breakdown of the funds by percentage, by contributing fund. It was just looking at the point on the UK Opportunities Fund, where obviously ourselves and Cardiff are the only two investors at the moment, us with 79%, Cardiff with 21%. It was really just, and again, in the light of what you're saying, Chair, is that sort of looking to be, do we think we're going to see a greater coming into this from other pension funds? It seems like we're being a slight outlier. You know, we've discussed it and we've taken this policy decision, but I'm just asking the question, are we seeing the likelihood of others perhaps tending to follow down that way? Because obviously it feels like that perhaps we're a bit more exposed in one area compared to others. Just my question.
Sure. Thank you, and a good observation. I think to the point about the fund being an outlier, just as a reminder, I think even before the Pensions Committee approved the latest investment strategy and strategic allocation this time last year, this pension fund has been a long-term investor in UK equities anyway, dating back pre-WPP. So our stance hasn't changed over that period of time. To the point about whether or not we think there will be more investment into that sub-fund over time, I think that potentially yes. As a reminder, the decision essentially will be for all of the underlying constituent authorities at their local pension committee levels to consider a strategic allocation of some sort, or whether their investment strategy merits that type of exposure. Historically, as you know, our fund has opted for predominantly a global equity allocation, but with regional allocations such as we've got Europe, we've got UK, we've got emerging market equities, we've got an Asian mandate, and we historically, although we still hold it, we have had an allocation to Europe as well. So some of it is just down to fund preference, but I think with the direction of travel, it may well be an area that others explore to support further UK investment over time.
Thank you both. Any other questions or queries on the report? No, in which case then let's move on to the recommendations. The recommendation is on page 101, if I can get it back up. It's relatively straightforward at paragraph 7, number 7.1. The recommendation is that the Pension Committee notes the content of the report as well as the respective appendices. Everyone happy to note the report? There we go, that's done as well. Next item then, staying with Alex, is agenda item 9, and this is the quarterly investment performance report up to the 30th of September 2024 that begins on page 123.
Thanks, Chair. Another of the quarterly routine items that we present to the Pensions Committee, so hopefully familiar with the structure. As a reminder, what I will do is essentially cover some of the very key messages from the last quarter as detailed within this report, and then turn to our advisors who are both in the room to discuss both the market and some specific reflections based on our quarterly oversight of these investments. So just as a reminder, this covers the quarterly period 1st of July through to the 30th of September. It's quarter 3. Again, the fund, as has been the trend for most of the year, has seen a positive return, albeit relatively modest compared to previous quarters and potentially the existing one that we're in. So the fund is up 1.6%, slightly outperforming the benchmark return of 1.56%. So in cash terms, that's a sort of £66 million increase, taking the fund to just shy of 4.4 billion. So still continues to work at that sort of record high level. And as you can see, the last 12-month performance has been pretty significant at just over 15.3%, slightly lagging the benchmark return, which is 15.7%. But just as a reminder, the broad objective of the pension fund's investment strategy is to outperform its actuarial discount rate. That is the assumption or key assumption that is made when we fund the liabilities of the scheme. And in the last formal review in 2022, that was set at 4.3% annualised return. So a return of 15% in any one period is significantly outperforming that, which in turn is helping support the sustainability and the funding of the scheme overall. Generally, although this report covers in a lot more detail where that performance has been good and bad during the period, we've seen the recovery in fixed income, most of our fixed income investments following a dismal year in 2023, but equities have also performed well, as have a number of our other asset classes. I'm sure Ethan will touch on that from a market perspective shortly. And I think just the other point that I always try to make in this update is to think longer term. As a reminder, the fund, using that analogy around our funding assumptions, is a 20-year time horizon, very long term, and so we look to those longer term periods of investment performance to determine whether or not we're on the right track. And I think at the bottom of page 123 in paragraph 3.3, we summarise across those various timescales. So 3, 5, 10-year performance, 5.27, 7.8% respectively, and even since inception, dating back to the 90s, that's 6.3% annualised. So that's comfortably ahead of that actuarial discount rate of 4.3 that I mentioned. I think at that point I may just turn to Ethan, who will present the macro update, which is copied in the appendix for you, and then we'll return for some concluding comments, perhaps on the quarter specifically from Betty and I.
Great, thank you. And just a reminder of why do we have this macro update. It's really to provide some context as to what it's like to be an institutional investor these days, where the opportunities are, and in particular a UK-based institutional investor with some pressure coming down, at least to keep some of that investment in the home country bias, and what that's like given what the opportunity set is like around the world. So it's a slightly longer than usual report this time because there was simply a lot to say. Since we last spoke, we've had now resolution of the uncertainty around the US election, and we know that with Donald Trump's election, everything that we had expected would come with the Trump trade has actually come to pass. So it is worth just running through those a little bit because it is how many of those has been reinforcing trends that are very much already in place. And those trends cannot be ignored because they will dictate essentially why a global investment mandate is so critical and how it's likely to be even more important going forward. So clearly we have even before Trump was elected, there were some trends that have now just continued. One of those is inflation being relatively tame, although we can never completely say it's in check. It is certainly moving in the right direction. That is enabling central banks to start to lower rates again after an unprecedented period of rising them in a very, very quick fashion. And lowering those rates, of course, is further stimulation to an economy for which the idea of recession and whether or not there will be a soft landing is looking increasingly in the rearview mirror, at least for the US. What we're also seeing is the Trump trade is starting to reinforce what was a trend already in place, which was the breakaway flywheel of the US economy, and the fact that that was being reflected also in markets. It's very interesting to look back at some 15-year charts showing how 15 years ago the US and Europe were approximately the same size in terms of their overall market cap, and now the US has completely outstripped that, but would now be 50% larger than Europe as an economy. So certainly it is critical to see why that is happening. There are a number of structural things in place. We have a very benign regulatory environment in the US. We also have companies that are getting larger, getting more pricing power, securing their margins. The point is that this breakaway isn't just about momentum, it's about actual fundamentals, and the fundamentals of US companies have been very strong, and that has enabled those markets to maintain their momentum. In comparison, UK, European markets have not had the same fundamentals. Companies haven't had the same earnings and resilience, and nor has there been momentum around that. So we've got a chart later discussing the UK participation by UK pensions and equities, and it is incredibly low relative to the rest of the market. So in terms of what kind of growth are we actually talking about? In the US, the growth is north of 3%, even to the point where there might be a worry about overheating. And if there is a worry about overheating in the US, that might well curtail the ability of the central bank, the Fed, there to drop rates. We can see from the page 134, the UK budget, they set out recently, they set out both their economic growth projections as well as their inflation projections. And certainly we're out of technical recession territory, but these growth projections around about the 1 to 2 range are nothing to write home about in terms of the UK, but they are at least positive. So no danger of overheating, I'd say, at least here. But there is still a sense that inflation is sufficiently subdued, around about the 2% mark and coming down over the next 5 years, that the Bank of England can be dropping rates, which it did do in 2 consecutive quarters. So in terms of the, I'll just move forward a little bit of this. The question is whether the easing is going to work, whether these rate cuts will work here, certainly to stimulate the economy. And in the US, there again has been some evidence that has been working, that whether it's to do with rates or simply the momentum forward, but we don't know whether the monetary easing will make a difference in Europe, because some of Europe's problems are too structural, too embedded, that it's unclear as to whether, even if the ECB does raise rates, drop rates right down, and even if the Bank of England does drop rates right down, will that be enough to turn around the economy here? That's a big question. Where are we focusing when it comes to President Trump? We can see that even though President Biden's still in office, technically, President Trump has been acting for all intents and purposes like the head of state, wandering around the world, meeting with, well, not wandering, but attending events around the world, meeting with other world leaders, clearly very much the strong arm approach to tariffs and to America first. So I'd say that those shock and awe tactics are already starting to be reflected in markets. We can see it in terms of the US market themselves, the fall away of markets that will be adjacent to that, Canada and Mexico, and very much they will be forced to comply in terms of these threats of tariffs. Even though tariffs are inflationary and generally bad for growth, the question is whether he will in fact go ahead with all of these, or whether it'll just be a tactic to assure compliance around things like immigration. We can see digital assets very much rising on the expectation of tailwinds there. Not something we invest in as a fund, but it is interesting to see that this risk-on has extended beyond financial assets in the traditional sense into something like Bitcoin. Gold has been popular. And all of this is happening against a backdrop here and there of a budget deficit that's rising. And the point seems to be that nobody really cares about that budget deficit rising because growth is so strong. You can grow your way out of a deficit problem, it seems, in the US. I'd say that's not the case here. When we do have a mismatch here, we don't have the growth that is persistent. It can become more of an issue. Government borrowing can become more of an issue here. And what we can see that when market participants, whether it's France or in the UK, have lost faith in a government's ability to balance its books, that will be reflected extremely quickly in a flight away from that country. So we've seen in France the rates on government bonds rise as political instability seems to be an issue there. And similarly here, even after the budget, there were wobbles in terms of demand for UK gilts. So again, not as much a captive audience in the UK and Europe as there's clearly a strong captive audience in the US. So this is all important because we have a strong global mandate. And our global holdings have done extremely well. Our non-sterling assets have done well. Sterling has been, again, weak in the last quarter. Where we will struggle is on the fixed income side when we see UK and Europe, there's not as much demand there. There's much more volatility in fixed income today. Even though rates are, in absolute terms, attractive, that volatility makes bonds a lot harder to hold with a sort of a calm outlook. I think it is important in this book to look at the slide 141, where we have a comparison of UK pensions versus pensions around the world. I think it is very notable to see how much UK pensions hold in bonds. That's not our case. We actually look at the polar opposite of this. This is bonds as a whole. But the bottom line is that the UK holds far less in terms of risk assets in its pensions than other pensions around the world. That's clearly something the government wants to address. We are not actually looking like this. We have an equity overweight relative to this. We always have had. That's why we've done so well. But I think this is the backdrop against which the government policy is being developed, knowing that pensions are underinvested. So should they look to mandate or to strongly encourage or orient towards more investing in the UK, it's precisely because we have so few incumbents investing there. And that is something that we can obviously address later, but we need to be mindful as to why these policies are developing. And again, looking at the fundamental drivers of UK equities versus non-UK equities, we would question whether there will be the return, the core return in UK equities that would justify that kind of an allocation. Finally, just to say, even since writing this, events have overtaken in terms of the geopolitical events. We've seen a non-stop volley of geopolitical shocks, I'd say, around the world in the last 18 months. None of them have tended to rock markets particularly, but certainly the fall of the Syrian regime in as little as 11 days is another sign that perhaps some of the axes of power or influence need to be reviewed. And one of those, the biggest axes of influence that we would need to rethink after the Syrian developments would be that of Russia and as well as Iran. So both of those seem to be much weaker as a result of this, particularly Iran. That could actually translate into better stability in the short term as the threats of both of these, both the cracks have been exposed, have been some more subdued. It certainly is the case that markets, we don't know what their reaction to Syria is yet, but if anything, the last 18 months are anything to go by, markets seem totally agnostic as to geopolitical developments. And that is an interesting thing, because you would expect them to at least have some discounting in of uncertainty, but it seems that there's very much just a focus on fundamentals. While that lasts, we don't have to worry too much about geopolitical impacts. However, we are going to be watching this going forward. Again, Trump is definitely going to be a mover on the geopolitical stage, so we need to see whether America First becomes even more reinforced. We should be looking at whether the US, now at 75% of the MSCI World Index, whether that's at a point which could in some way be at a peak, and whether Europe and the UK start to participate. We have global exposure, it doesn't matter, but if the US is peaking, our dollar exposure will cost us, although we do hedge more than many of our peers, so that isn't as much of an issue. And then again, rate cuts. If rate cuts are accelerating, that will be stimulating for our assets such as real estate and infrastructure, but it will erode our ability and what we can earn on our bonds going forward. So I'd say that is really the state of play as it stands. I should say, just in terms of training, I do a podcast now once a week that is some of this in shortened form. So if that's ever of any interest in terms of training, that's something that is accessible.
Thanks, Stephen. I suppose any questions? Chairman, any questions before we conclude the report?
Betty's got a hand up, but any members got any questions of Ethan or Alex first? Betty.
I just want to clarify one thing. The numbers that are presented in the report of performance are for Q3 ended September 30th. And one of the big drivers actually was the fact that sterling had appreciated substantially over Q3. Ethan is talking more about Q4 through now, where sterling has then retreated. So this is not a contradiction. So we're talking about different time frames, but it did have an impact in reported performance, but not underlying performance. I guess the other thing I would say is the comparison about pension fund allocations. I think to do a more intellectually honest calculation, I think that's to note to Rachel Reeves, you really need to split out what are open funds versus closed funds. The UK has a lot of closed DB schemes that are not open to new members. The US closed DB schemes for mostly, except for the public sector, about a generation ago. So most of those US funds, pensions, are actually defined contribution. They're not defined benefit schemes, and so of course they will have a much greater exposure to risk assets. So I think that it would be to draw any more meaningful conclusions once you really extract the closed schemes and then see where you compare. And Japan probably the same as I assume there's a lot of closed stuff there too. So that's not really a very you can't really bash the UK saying we have too much in bonds because our structure of our pension industry is so different than other countries. And then finally, your comment about Trump, I mean, it'd be interesting to see where he goes. There's been a lot of analysis of why he won again, and regardless of what anybody views about this, there are some, conclusions about, it was the economy stupid. It was, what Americans think about, going to the grocery store and filling up their car. It really wasn't about, whether the Fed had engineered a soft landing or something. And another thing that people have been commenting on is that you can have actually some pretty smart, far-thinking policies like the Inflation Reduction Act, which really spurred a lot of onshore investment in renewables and really has helped to catalyze the shift away from fossil fuels in the U.S. Nobody talks about that. They just do it. I mean, it's good business. And then second of all, this reshoring. But sadly, people don't get credit for smart policies in democracies which are dominated by, certain sound bites on social media.
Okay, sorry, there was a lot to say this quarter, so to say. I suppose just to conclude the message, just so we know why exactly we had this long discussion, it is a pretty good time to be an institutional investor today. It's not something that's taking a lot of airtime. It's not something that we're going around troubleshooting and saying why this is wrong, why this wasn't wrong. So I think that is a nice context in which to understand these returns. It's also a nice environment in which to even engage in these pension discussions, because we are sitting at a place which for funding levels are strong. And I suppose the question is what could cause it to change. Being broadly diversified is a good way to insulate against that change, and we've certainly made steps in that direction, so that's been a good thing. We do need to ask ourselves whether this perfect storm of essentially the eye of the storm when it's all calm, whether that can change, and what could it be that could tip markets into some kind of a free fall. I would think that it would be unlikely that that's going to happen, so that the European markets do extremely well and that US markets crash. I think there's going to be full contagion, and I don't see a reversion to the mean in terms of this diversion between the US and Europe. And finally, just in terms of private credit, that's an area we've been working on for some time. Again, back on the tune that is a good time to be an institutional investor, and private credit is now $3 trillion. So it is reaching mainstream. It is no longer shadow banking. It is fully, I would say it's now becoming a mature asset class that we are now participating in. And it's good, again, more diversification, and we're not on the fringes in doing that. We're in the mainstream. So I think that's all just a good backdrop.
Thank you both. And before Alex comes back in, just to go back to some of Betty's points, I think you're completely right to point out the differences between the types of scheme we're talking about over here. But then it is also one of the reasons why in the pensions review, the government has gone down the route of actually trying to encourage the consolidation of those DC schemes into bigger super funds anyway, so we can maximise the investment and capital potential. But then it's also, I think, a reflection of where we're likely to, or potentially could be in the next 18 months. Let's be perfectly honest with the onshoring. Biden has taken a sort of a very, say it quietly, Biden has an America First policy actually in the last 4 years. It's just going to be shouted much louder with Trump coming in. I think my reflection on that, and it's not the reason, it was never at the forefront of my mind about some of the investment decisions we've taken. I think I'm quite pleased that we've taken decisions in the last 2.5 years to be more actively investing in UK economic assets, because I think, quite frankly, the next couple of years potentially could be rocky in terms of where that money is coming from, and we also need to be looking to ourselves. And that was one of the main reasons why we took this turn in the first place. But let's hope it's all going to be a lovely sunny 4 years after, orange sunny-faced 4 years after President Trump resumes office in January. Alex obviously isn't past comments on that, but you can finish off the report.
Thanks. I think that the concluding comments I would make, and I'm moving back to page 127 of the papers, which is the main body of the report. Obviously, what keeps us busy as officers is ensuring that we align our long-term strategy with that agreed at the Pensions Committee in December last year. We talked a lot about generally positive sentiment, that the fund is performing well. We've had the market backdrop, but I think what's important for members just to remain mindful of is the ongoing work that we need to continue with, which is sort of summarised on page 128. And as a reminder, what this is a snapshot of the pension fund, how it's allocated at quite a detailed level, really, across the various mandates within those asset classes, equities, fixed income, multi-asset, etc. The middle column is showing the market values at the date of 30th of September. As we move to the right-hand side, it shows actual allocation percentages relative to those strategic weightings. And as you can see, the real outliers continue to be equities, i.e. we are quite considerably overweight our equity allocation in the long term, and we remain quite underweight that real assets allocation, which is essentially the comprising of real estate infrastructure. And so the work that we've been doing, and we've made more progress this year, there are a couple more items on the exempt part of the agenda to consider additional and new investments through the WPP into these areas. I think over time we will see that transition where we will realise our equity investments and reallocate that into real assets. So the footnote on page 128 summarises the interim ranges that we agreed with the committee in December last year. This was really with a view that, you know, over a 12-month period, maybe over a 2-year and then a 3 to 5 year, how we would achieve those long-term target weightings. And I think we've made good progress during this calendar year, but clearly more to be done in 2020, 25, 26. The final couple of pages really just summarise information we've already discussed, so I don't need to repeat that. It's there for your information. You'll receive the next quarterly update in March, which will consider performance that captures some of Ethan and Betty's comments through the current quarter. And I think at that, Chair, I'll turn to you for recommendations.
Thank you very much. I mean, just final comment from me is just a reflection. I mean, looking at the growth of the fund, if we're looking towards the point of the next election here, so what, so spring 27, so conceivably the fund could be sort of worth £5 billion by that point, sort of spring 27, on the current trajectory, which is not a bad showing. Right, in which case then, page 131, it's paragraph 11, the recommendation is at 11.1. It's recommended that members note the investment performance that has taken place during quarter 3 of 2024. Are we all happy to note the fact that happened? Excellent. Well done, everyone. Next item is still with Alex. This is the risk register, which starts on page 167.
Thanks, Chair. So I will cover the first part of this item, and then I'll just turn to Joe to make a couple of comments on some specifics. So, as ever, this is another of the quarterly items that we present to the committee. We also take this through the local pension board, which is the forum really where we have detailed discussion on underlying risks. As a reminder, we took a decision perhaps 12 months ago now, maybe even a bit longer than that, to essentially split the risk register into a strategic document which covers the sort of dozen most significant risks that we consider across administration, finance and investment, and fund governance. But underlying within that is an operational document that has sort of 30 additional risks, and they are, as the name suggests, operational in their nature, but I think in aggregate evolve into that strategic document. So what you have in the appendix is the strategic document. We've agreed that at one point every year we would bring the full suite of risks for completeness, but tend to focus quarterly on the sort of dozen risks. There were a couple of updates that we worked with the board at the last opportunity in October, and a couple of risk scores were amended as a result, or at least one on top page 168. This was in regards to the Wales Pension Partnership. And actually there was a comment made from the board, which I think was fair. We'd obviously gone through a detailed procurement exercise earlier in the year to reappoint the operator to WPP, which is Waystone. They were reappointed following a competitive process, and I think given where we assessed that risk to be, we made a decision that we thought the residual score could be reduced on the impact of that, given that we've made that long-term appointment and really assessed the market, having not done so since about 2016 or 17 when we first appointed them. There were a couple of other minor updates that we've made, largely informative around controls. They are all highlighted in red text, and I appreciate it's quite a difficult document to read within the agenda itself, but I'm happy to circulate a separate copy if it's helpful for members. I think the final point to note, and I'll just invite Joe to make a couple of comments, Another area that we've developed within the risk register review, and again taking views from the local pension board, is around essentially developing a risk-in theme on a quarterly basis. This is the idea to bring some of the risk register really to life, and we've tried to do that in a timely manner around specific updates, so whether that's sort of an agenda item or a particular topical issue. And over the last quarter, what we've looked at is cyber security and the General Code of Practice, both of which have been referenced already on the agenda today, but largely follow training and other ongoing work that we thought was sort of quite timely for members to benefit. So we hope that using a risk-in theme approach moving forward, it allows members to drill down into aspects of the register that we haven't perhaps done as much of in the past, to really understand how these risks are developed and how we assess them. And on a forward-looking basis, we will evolve that around the 3 categories. So it might be that in March we discuss funding and investment, and that may be around the triennial valuation, which would be on the horizon by that point. Joe, I don't know if there's any particular comments you may want to make just on specifics as a result of that risk-in theme that we've had this quarter.
Thanks, Alex. I'll just run through the 2 risks that we've identified that we've looked at over the past quarter relating to cybersecurity, and it is quite fitting as we had the cybersecurity training at the last Pensions Committee meeting and the updates today. So the first risk is a serious cyber attack leading to disruption to the discharge of administering authority functions. So this could lead to the misuse of data, resulting in a number of consequences for the fund, including disruption of service, stolen data, ID theft, inability to access the data, and ultimately reputational risk. So based on that, the inherent risk is 20. However, the fund does have a number of controls in place to manage this, many of which you'll be aware of. I have my monthly meetings with the Chief Information Security Officer to review the cybersecurity risk register. We also receive training about cybersecurity. Monthly scans are carried out on the website and for cookies. And the Chief Information Security Officer ensures that we are compliant with national cybersecurity best practices. And we receive a half-yearly cyber preparedness report from the officer. As you just heard, we carry out an annual tabletop exercise with Hayward Pension Technologies. SRS have a business continuity plan in place, which is reviewed by the Chief Information Security Officer, and the Council has procedures in place in relation to password and access to systems. So based on all those measures that we've put in place, the resulting residual risk is 12. Just moving on then to the second risk, so failure to administer and comply with the local government pension scheme in accordance with the regulations and the Pension Regulator's new Code of Practice. So the result of this could lead to errors in administration of the scheme, leading to incorrect benefits and financial and, once again, reputational risk. So the inherent rate for this risk is 16. So the controls that the fund has in place to manage these, so officers keep abreast of developments and regulation changes throughout the year. We receive regular updates from the Local Government Association, actuaries, pension officer groups. I sit on the National Pension Officer Group, and I'm also chair of the Haywards Class Management Team. We as a fund collaborate widely with the Welsh and UK funds. We attend regular events, for example conferences organised by industry experts, and we're also audited internally every 3 years covering administration, governance and investments. We have a communication strategy in place which sets out communication methods, and following today's meeting we'll also have an administration strategy in place, setting out the roles and responsibilities of the fund and its employers. Our pension system is upgraded 4 times a year to ensure that it complies with the regulations, and officers receive regular training, attend regular training events, and we have a plan in place for all fund officers to ensure that they maintain a knowledge and experience of the regulations. And finally, as you're aware, the fund's purchased Timers Robinson's Code of Practice checker to ensure that we comply with the new Code of Practice. Obviously, Pensions Committee will be kept abreast of that. So following all those measures we've got put in place, the resulting residual risk is 12.
Thanks, Joe. I think that really concludes the substance of the report, but I haven't seen any questions or comments on that.
Okay, thank you both. David's indicated, but before I bring you in, David, again, Ian, is there anything that was brought up specifically at the board that you think it would be useful for members of the committee to be made aware
of? Thank you, Chair. As just been explained by the officers, we effectively operate a rolling review of the risk register now, and the comments that have been made at each board meeting are taken on board by the officers in terms of the report presented to you. So again, nothing additional beyond what you have before you. That reflects the comments made at the last meeting of the Pension Board. Thanks.
Excellent. I love it when a plan comes together. Thank you very much for that. Now, David's indicated, then I'll take John or Carl afterwards if there's anything you'd like to add.
Thank you, Chair. It was only on the last risk that you went through, Joanne, and obviously you previously reported that we've got the sort of software to sort of look at the pension regulations. I just wondered if that ought to be referenced as a mitigation action within the risk register as an opportunity, given it's something that has recently been reported. Just an observation.
And a valid one, Jen. Any response?
Yes, no, I agree. I think definitely we should include that in the risk register. We'll update it for the next meeting.
Excellent. With that, then, I'll take it that we're happy with that item. So if members could turn to page 168 of the report, the recommendations at paragraph 5, it's 5.1. The Pension Committee are asked to note the updated risk register. Everyone happy with that? Excellent, in which case that is also done. Back to Joanne then. Agenda item 11 is elected member training. Starts on page 175.
Thank you, Chair. Just a couple of updates from me. So Pension Committee training logs are appended to this report as per usual in Appendix 1 and 2. And also we have the training programme for 24-25 at Appendix 3. We will be reviewing the training programme in the new year and present that to committee at a future date. Just a couple of updates on the National Knowledge Assessment. So this was commissioned by Hymans Robinson and it is now closed. So the fund is expecting to receive the report from the actuary in the next coming weeks, and we will bring this back and present it to Pensions Committee. And then I just also wanted to touch on LOLA, so the LGPS Online Learning Academy. So during October, you should have all received access details to be able to log on to LOLA. And so I'd just like to take this opportunity to encourage you all to log on at your convenience and participate in LOLA. And all feedback on the course will be welcomed to assist with the development of the 24-25 training programme.
Okay, thank you and well done to all the members that filled in the training knowledge assessment. Does anybody else have any questions, any comments on what Joanne said? In which case, I think if just move on to note in the report then, that's on page 176. Recommendation is at paragraph 6 at 6.1. It's recommended that the Pension Committee notes the training update and we've commented where appropriate. So everyone happy with that? Excellent. Thank you very much, everyone. We have whizzed through today. Agenda item number 12 is the date of the next meeting. That is currently scheduled for the 17th of March 2024. That's for noting only. Before I move on to agenda item number 13, which is the exclusion of the press and public, I forgot at the beginning of the meeting to introduce Andrew, our new Section 151 officer, and to say some comments to embarrass Nigel on camera before we switch it off. So, At the meeting of the last full council, Andrew Lovegrove was agreed by members that Andrew is now officially the Section 151 officer, as he's taken that responsibility. And Nigel, who's been the 151 officer, and as I wax lyrical in the annual reports, has been his literally man and boy at Torvine for the last 40 years, is leaving finally. This is a bit like a Frank Sinatra sort of like retirement tour in the 1970s. It's not quite Caesar's Palace or Madison Square Gardens, but we are in the council chamber today to say thank you very much for all your hard work, both for the authority and with the fund over those years. I know we've only had 2.5 years of actually working together. I've known of your presence for much longer than that, but I would like to put it on record to say thank you very much for the support and the guidance you've shown me as someone who knew nothing about this when I first came onto the committee 2.5 years ago. But I think you've done a fantastic job with finances for the authority and also providing that presence for the authority over those years. And I think you're going to be both missed at the authority and at the pension fund. So, like I said, just want to say personally and also sort of as chair of the committee, thank you very much for all your hard work and your support. And I'm also happy for you to say a couple of words if you'd like to.
I'm never one to turn down saying a few words. Thank you, Chair, for those kind comments. Yes, 31st of January, I finally end my farewell tour. Yeah, I think I've been treasurer since around 2005, so that's quite a long time. I think the fund was something like 55 or 60% funded then, so it's come a long way since then. Pooling was not even thought of, and I was there at the start of that and all those conversations to try and get that done. And Wales was ahead of the curve then. We did it, or were trying to do it, before George Osborne made his statement. So I think the pension fund and the pension committee is in a healthy state, because pension committees didn't even exist back then. It was just fund panel meetings and off to London. That's what it was. So yeah, I think it is in a good state. You're in good hands, with Andrew, who comes with a wealth of experience of pension funds from various other roles. But even if Andrew had no experience, I think we've been very lucky with Alex. We've developed Alex to look after that, and we've always been lucky with Joe. So I don't think, irrespective, and not wishing to in any way belittle Andrew's role, I think even without Andrew, the fund was actually in very capable hands with Alex and Joe. And yes, my last council will be the 21st of January. So if you want to hear me say some more words, log on to that council, when I'm going to use my role in charge of making sure the agenda's all in, to give myself a speaking role on that as well.
Well, I can't wait. I can't wait until that rendition of My Way is sung across the council chamber, if that's the case. Before I'm going to ask members to sort of formally note our thanks to Nigel. Andrew, I just wondered if you'd like to sort of introduce yourself in a couple of minutes, because obviously, as Nigel has suggested, Andrew actually comes with professional sort of LGPS experience, which I think will be very, very, very helpful in the wars to come.
Thank you, Chair, and thank you for the welcome, and thank you for Nigel's kind words. I have been around a bit, if that's the right phrase, so I have been involved at Warwickshire Pensions, and as Nigel mentioned, the pooling debate was quite interesting there. Warwickshire wanted to explore both options, so we had conversations with a number of potential pools on there, so I've been through that process and the setting up of Balderstone Coast. I then arrived at Herefordshire, and Herefordshire and Worcestershire have their joint scheme. I did various roles within that arrangement, actually sitting on their pensions committee. So I have a lot of experience of LGPS and various bits and pieces along with it. But it's a fantastic team, so it is very much a team effort. And going with Alex and Joe and the rest of the team, they've got a real good grip of things. And an exciting time going forward into LGPS space, the pensions review, and as Nigel said, Wales is always on the front foot, so we're really looking at exciting opportunities.
Thank you very much. If I can then, can I ask members if we're happy to formally note in the minutes our thanks to Nigel over the years? Everyone happy with that? I'm looking forward to raising a glass of something at the end of January. Right, agenda item number 13. This is the exclusion of the press and public. So, to agree the exclusion of the press and public from the meeting as presentations and meeting papers are not for publication because, in accordance with paragraphs 12 and 14 of Part 4 of Schedule 12A of the Local Government Act of 1972, as amended by the Access to Information Variation Order Wales of 2007, it contains information about a particular individual and information relating to the financial and business affairs of particular persons, including the Council, and in all the circumstances of the case, the public interest in maintaining exemptions outweighs the public interest in disclosing the information. Are we all happy with that? Excellent. In which case then, if we can turn the camera off, but before you do, Jade, I'd just like to wish everybody watching a happy Christmas.